Welcome to the Deep Dive. This is the show where we take a whole load of sources, articles, research, and boil it all down into the key bits of knowledge just for you, our listener.
That's right.
And today, we're diving deep into something that honestly might make you pause. Could a company known worldwide for, a sausage roll, actually be a, quote, world-class business?
Or even an undervalued money-printing bakery. It sounds a bit over the top, maybe.
It does, but we're going to challenge that perception. We're looking at Greggs PLC.
Ah, yes, Greg's, the UK's #1 bakery chain, no question. And the story, it's quite something. You go from John Gregg back in 1939, literally delivering eggs and yeast on a bicycle,
Bike, right.
to now a market cap over £2 billion, more than 2,600 shops. It's a journey, a masterclass, really.
And to unpack all this, we've got some great sources. There's a really detailed deep dive from an ACCA professional digging into the financials, the strategy, proper stuff. Then we've pulled in investor updates, analysis from financial experts, and, the commentary from financial content creators online, the ones watching the stock like hawks.
Yeah, there's quite a bit of chat about Greg's online, isn't there?
There really is. So, our mission for you today, we want to pull out the key reasons how Greg's got so big. How did they handle the bumps in the road? What's next?
And why do some people look at it and just see, a boring defensive stock, while others are, as one source put it, greedy for a triple portion?
Exactly. We'll look at the big decisions, the money side, the community feel. Even that makes it way more than just a bakery.
Yeah, it's got that certain something.
But first, we absolutely have to set the scene. The market feeling around Greg's lately, it's been rough, despite news often sounding quite positive, expansions and all that.
The stock price hasn't reflected it.
Not at all. Down 45% since September 2024, 37% just this year so far. So there's this real tension, isn't there? Good news from the company, bad reaction from the market. Why? That's the puzzle we're going to try and piece together for you.
Okay, let's start at the beginning then. To really get Greg's now, you need to see where it came from.
Right, 1939.
Yeah, 1939, Britain, cusp of the war. John Gregg starts out just him and his bike in Newcastle, not a shop, just delivering basics, yeast, eggs, bread, door to door.
Just essentials, helping people out, really.
Exactly, small scale, very local, a world away from, a £2 billion company.
It really is staggering, that contrast, from pedal power to, serious financial power.
The big shift came in 1951. That's when the first actual Greg's shop opened.
The very first one.
And from that single shop, they just grew steadily, methodically. Now over 2,600 shops across the UK. It's proper disciplined growth over decades.
And yeah, everyone knows them for the sausage roll, don't they? But they actually do a lot more these days.
Oh, definitely. The range is pretty wide now. Pastries, sure, but also pizzas, sandwiches, donuts, cakes, coffee. It's a whole menu.
But let's be honest, the sausage roll is king.
It is. Undisputed king of sausage rolls. That's what it is. Almost a national symbol.
And I love how they describe it. Seasoned sausage meat wrapped in layers of crisp, golden puff pastry. Okay, standard enough.
As well as a large dollop of TLC.
Huh. That dollop of TLC, that says it all, doesn't it? It's not just food, it's comfort. Reliable, affordable.
It is, and that connection, it goes deep.
Yeah.
Greg's isn't just another chain. It's become a bit of a cultural thing.
You see it online, right?
Absolutely. The social media numbers are huge. 730,000 plus on Facebook, 200,000 plus on Instagram. And get this, over 61,000 people in the Greg's Appreciation group on Reddit.
Wow. That's passion.
It is. They're not just customers. They're fans, advocates.
And you see all those videos, YouTubers, TikTokers reviewing the latest bake, the festive pasty, and they get millions of views.
Constantly.
So is that just clever marketing, or is it something more? Why is it more than just a bakery? What makes it part of the sort of cultural wallpaper?
I think it links back to that TLC's bit, It's partly ubiquity, they're everywhere, partly affordability, always seen as good value, and it's just unpretentious. It cuts across all walks of life.
Yeah, everyone goes to Greg's.
Exactly. It's that reliable constant on the high street, a shared experience. People joke about it, make memes, queue up for the Christmas bake. It's familiar, comforting.
But this cultural status, it didn't just happen by accident, did it? You mentioned a big strategic shift.
Oh, absolutely. A really pivotal moment. We need to talk about 2013.
Okay, what happened then?
Roger Whiteside was CEO, and he looked at the numbers and saw, clear as day, 80% of their business was already what they called food on the go.
Fudgy.
80%.
Are you
So
serious?
mostly people grabbing something quick to eat then and there.
Precisely. And based on that, he made a really tough decision, a bold one,
Which
to
one?
stop selling traditional loaves of bread and scones in lots of their shops.
Wow, hold on. A bakery chain
Yeah.
stopping selling bread? That's huge. That's like 20% of their business gone. It was a massive call, giving up a fifth of your business, a core product. But the strategy was clear. Focus everything on the commuter, the person needing quick, convenient food. Double down on 5G.
Okay. So that focus must have triggered a whole load of changes. How did they actually pivot?
Well, first off, they expanded the breakfast menu massively. And they started opening earlier, staying open later, catching people on their way to work, on their way home.
Right, extending those day parts, as they say.
Exactly. Then came the digital push.
Yeah.
The Greg's app launched in 2014, pretty early for a bakery, really.
Yeah, ahead of the curve there.
Then the drive-thrust started appearing in 2017. Hugely popular.
I bet.
And by 2020, they were doing home delivery through Just Eat, and later Uber Eats joined too. That delivery slice is now, what, nearly 7% of sales?
6.8% in the first half of 2025, yeah. That's a significant chunk. It's a proper multi-channel approach now.
Very much so. And don't forget the supermarkets. They started partnering with Asda and Tesco in 2020. Then Sainsbury's, popping up inside bigger stores.
Right, reaching people who might not walk past a standalone Greg's. Smart.
It means you find Greg's everywhere now. Traditional high street shops, yes, but also smaller spots and travel hubs, those drive-thrusts, trials of 24-hour stores, outlet shops.
Franchises, too, and those supermarket concessions, it all adds up to that reputation. Freshly prepared products and convenience. They really have adapted.
They really have, meeting the customer wherever they are.
And that adaptation, that whole pivot, was fueled by a real engine of growth, wasn't it? You mentioned store expansion and economies of scale.
Yes, precisely. Two key things driving it. First, just relentlessly opening new shops. On average, about 5% more stores each year. Steady, consistent growth.
And they're not slowing down, are they? Aiming for 140, 150 net new openings this year, 2025, after a record 226 last year.
Yeah, 2024 was huge for openings. And the long-term goal, over 3,000 UK shops, maybe even 3,500 eventually.
3,500 Gregs, just picture that.
It's ambitious.
Yeah.
But look how they're doing it. It's a balanced approach.
Yeah.
Franchises came in around 2012. They're now about 20% of the total.
Right.
But over the last decade, the number of shops they run themselves, the owned stores, grew by 464. And franchises grew by 456. Almost identical growth from both sides.
Interesting. So using franchise money, but also investing heavily themselves.
Exactly, a dual track. And underpinning all that expansion is something customers don't really see, but it's crucial, their vertical integration.
Ah, right. Meaning they control a lot of their own supply chain production.
Yes, very much so. They have their own bakeries, their own distribution.
Yeah.
Why is that important? Two big reasons.
Go on.
Quality control, first. Consistency across thousands of shops, they control it. Second, and maybe even more vital for their model, cost efficiency.
Right, because they're not paying markups to suppliers or logistics firms.
Correct. They manage ingredients, production, delivery. That helps keep prices down, which is core to the Greg's brand and protects their margins.
And you can actually see the evidence of that efficiency, those economies of scale, in their staffing numbers versus output.
Yeah, the numbers are quite telling.
Yeah.
End of 2024, you had what? Just under 800 in management, about 500 in admin, nearly 4,000 in production, and then the big one, over 27,000 in the shops.
Okay. But over a decade, the number of shops grew 54%. Management staff only up 11%, admin 13%, production 24%. That looks efficient.
It is. Now, shop staff numbers did go up more by 74%.
Right.
But that makes sense, right? Longer opening hours, those 24-hour trials. You need more people on the ground.
True. But the key thing is the leverage.
Absolutely. Over that same decade, revenue up 140%, operating profit up 167%.
Wow. So profits growing much faster than overheads. That's textbook scale advantage.
That's exactly what it is. And they're doubling down on that advantage with massive new investments in their supply chain.
Right, these new huge distribution centers. Derby, that opened last year. Logistics go live H1 2026 for frozen stuff.
And then another one in Kettering coming online H1 2027 for chilled and ambient goods. These are enormous projects.
Huge cost up front, surely. What's the thinking there? Long-term play.
Definitely long-term. One analyst called it short-term pain for long-term gain. And that sums it up perfectly. These centers give them the capacity and the efficiency needed to support that 3,500 shop target.
So building the infrastructure before they hit capacity bottlenecks.
Exactly. It's proactive, building the foundations for the next decade of growth, ensuring they can keep costs low and quality high, even as they get much, much bigger. Foundational work, really.
Okay, so that's the growth story, the strategy. Sounds pretty solid. But as we said, Greg's has hit some turbulence recently. Those H1 2025 results. Let's unpack those.
Right. The headline numbers. First half of 2025, total sales up 6.9% to just over £1 billion.
Which, on its own, sounds okay. Decent growth.
You'd think so. But the devil's in the detail. The really crucial number is like-for-like sales growth in their own managed shops.
So stripping out the impact of new openings, how did existing shops do?
Only up 2.6%.
Oof, that's not great, is it? Especially with inflation.
Exactly. Franchise like-for-likes were a bit better, 4.8%, but that 2.6% in their core estate really spooked investors. And the profit numbers followed. Operating profit down 7.1%. Pre-tax profit down 14.3%.
Which led to them saying full-year profit would be modestly below 2024, a downgrade.
A clear downgrade, and the market reacted instantly. Stock dropped sharply.
Yeah, 4.7% drop on July 29th alone. So why the big negative reaction? What were the main worries?
Number one was that slowing like-for-like growth. It's been trending down from 11% to 5.5% in 2024, now just 2.6% in H1 2025. Actually, it was even weaker earlier in the year, 1.7% before picking up slightly to 2.8% in Q2.
And the killer point is that 2.6% is less than inflation, right? Expected inflation was around 6%.
Precisely. So in real terms, sales volume or value per customer in existing shops was actually going backwards. That's a major worry for a growth story.
And then a cost side. Obviously, inflation is hitting everyone.
Yeah, Grace is facing about 6% overall input cost inflation this year. Ingredients, energy, everything. But the big one for them with so many staff is wages.
Ah, the national living wage increase.
Yeah, up to £12.21 an hour from April. That pushed their employment costs up by an estimated 8%. Distribution, selling costs also rising. Costs going up faster than sales. Profit gets squeezed. Simple maths, unfortunately.
And then there was the weather excuse.
Huh. Yes. Management blamed hot weather in June for hitting sales. People didn't fancy hot pastries, apparently.
I mean, maybe bit, but enough to significantly impact a billion-pound company. The market didn't seem convinced.
Not really. Commentators pointed out other food chains weren't blaming the heat wave to the same extent. It felt a bit like finding an excuse, perhaps, especially as they've blamed bad weather in the past.
Right. Can't win. Cold is bad, hot is bad.
It just didn't land well, seemed inconsistent.
Another factor they mentioned was increased shoplifting and the response locking up sandwiches behind the counter in some places. Could that backfire?
It's a real worry. Great for loss prevention, maybe? But Greg's is built on speed and convenience, grab and go, if you have to ask someone to unlock a sandwich.
It adds friction, slows things down, might put people off that impulse buy.
Exactly. So could combating theft actually hurt those crucial like-for-like sales numbers?
Yeah.
Analysts are definitely watching that.
And finally, the big one affecting the short-term profit numbers, capital expenditure, CapEx. H1 2025 was a peak CapEx period.
Massive spending. $172 million in the first half compared to $102 million the year before. Planning $300 million for the whole year. Building those distribution centers, opening stores. It costs a lot up front.
So how does that heavy spending depress the profit figures we see, and what does owner earnings tell us instead?
Right. When you spend huge amounts on growth projects, that cash outflow hits your reported profit and free cash flow right now. It makes the current numbers look weaker. But owner earnings tries to look past that. It asks, how much cash does the business generate just running its existing operations after the basic maintenance costs? It strips out the big, lumpy growth spending.
So it's a better guide to the underlying sustainable profitability during these heavy investment phases.
Often, yes. It helps you see the core earning power separate from the temporary impact of major growth investments, like Greg's is doing now. You need to look at those owner earnings to gauge the real health.
Okay. Beyond those H1 results, there were other background worries for investors, weren't there? That overall growth slowdown.
Yeah, moving from double-digit growth to mid to high single digits, that changes the perception, changes how the market values the company.
How so? Leads to lower valuation multiples.
Often, yes. The PE ratio, price to earnings. Investors pay more for faster growth. If growth slows, even if it's still decent, they might only be willing to pay, say, 15 times earnings instead of 20 times. That multiple compression can hit the share price, even if profits are still growing.
And what about the leadership? Roisin Curry, the CEO, some chatter that she's maybe just following the old playbook.
That's been voiced, yes. She's continued the successful strategy from Roger Whiteside, no doubt. But some analysts are looking for her distinct vision for the next phase. In this market, just more of the same, even if it worked before, can make investors a bit hesitant. They want to see the next big idea.
And then there was the insider selling. The CFO is selling a load of shares back in October 2024 before the big stock drop.
Yeah, that didn't look great, did it? When a top exec, who knows the business inside out, sells a big chunk of their shares, it can signal a lack of confidence.
Especially before a price fall, and nobody seems to be buying the dip now either.
Exactly. It raises eyebrows. Makes people wonder if the insider saw trouble coming. It definitely added to the nervousness.
Okay, so those are the headwinds, the concerns. But there's a strong counter-argument, isn't there? Particularly debunking fears about cannibalization and market saturation. Let's tackle cannibalization first, the idea that new Gregs just steal sales from existing ones. Dismissed as utter nonsense by some.
Pretty much. And Greg's has the data to back that up, mainly from their app users. They can track where people shop. And they found, even if a new shop opens within a mile of an old one, 95% of the new shop's customers are genuinely new custom for that location, not just people switching from the nearby older store.
95%, that's huge. So they are tapping into new demand.
Seems like it. Plus, 60% of the shops they opened in 2024 were in areas with no Greg's within a mile anyway. Truly new ground. And they relocate stores too, about 14% of it since 2019, to optimize locations without just stealing from next door.
So the data really pushes back against that cannibalization fear, and that links to confidence about market capacity, right? They don't think the UK is full of Gregs yet.
Not by a long shot. Think about it this way. Right now, there's one Greg's for every 26,000 people in the UK, roughly. Their target of 3,500 shops works out to one per 19,000 people.
Okay.
But here's the clincher. In their most successful dense areas, they already operate at a density of one shop per 15,000 people.
So there's proven potential to go much denser than their overall target, especially in places they haven't saturated yet.
Exactly. Loads of room to grow before hitting a ceiling, especially in certain types of locations.
And they've got case studies showing adding stores can actually boost overall business in an area. Newport, you mentioned.
Yeah, Newport. Population about 320,000. Went from 7 shops pre-2016 to 12 now. Potential for 17, they reckon. And what happened?
What did happen?
App customer frequency, how often tracked customers visited, doubled. From 8 times a year to 16. More shops meant more visits.
Wow. Counterintuitive, almost.
And the finances backed it up. The overall earnings, the EBITDA, for the Newport area more than doubled, from pound 6 meters to £1 4 meters. And the return on investment actually increased from 29% to 36%. More shops, even more profit, more efficient profit.
And that wasn't just Newport. Bradford. Coventry.
Same story. Bradford. Doubled shops, doubled app frequency, ROI up from 26% to 36%. Coventry. More than doubled shops. Frequency up from 5 to 13 times a year. ROI up from 30% to 37%. It's a consistent pattern. Adding stores strategically grows the whole market for them.
That really undermines the cannibalization argument and underlines the productivity point. New shops opened last year brought in 10% of H1 2025 revenue, disproportionately high.
Yep. New stores are pulling their weight and then some. They're value additive, not destructive. It's a strong rebuttal to the bears.
Okay, so putting aside those concerns, what about future growth? Where are the new ideas, the innovation levers they're pulling? Menu expansion seems key.
Definitely. They're constantly tweaking. Bringing in things like the pizzas, chicken goujons, wedges, even that viral mac and cheese.
Yeah, that went nuts on TikTok.
It did. Plus expanding healthier choices. Pastas, flatbreads, yogurts, and rotating things seasonally keeps it fresh. It's about broadening the appeal.
And targeting different times of day. That evening trade push.
Big focus area. Evening sales are up to 9.3% of the total now, from 8.5% last year, driven by longer hours, expanding evening meal deals to more shops, and made-to-order options in over 300 locations, trying to capture that dinner market.
And the over-iced drinks now in 1,400 shops? How significant is that, really? Just iced coffee?
It's smarter than it looks. Think about it. Sausage roll sales dip in a heat wave, maybe, but iced latte sales soar. It helps balance out those weather impacts we talked about, broadens the appeal, boosts the average spend, makes them relevant whatever the weather. Simple, but effective.
Makes sense. And digitally, the app's adoption is flying. 25.7% of transactions scanned now. What's the strategic win there beyond just loyalty points?
Oh, the data is gold. Pure gold. They see exactly what people buy, when, where. It lets them personalize offers, target promotions, refine menus, even decide where to open next. It's a direct line into customer behavior. Hugely valuable.
And in-store tech, those new ordering kiosks being trialed.
Dual purpose, really. Efficiency potentially frees up staff, speeds up queues, and maybe increases average spend. Kiosks are good at suggesting extras. Plus, the delivery side via Just Eat and Uber Eats keeps growing steadily.
And behind the scenes, big tech upgrades happening too. SAP migration, AI for customer relations.
Yeah, that's the less glamorous stuff, but it's vital for scaling up. SAP provides a much more robust backbone for the whole operation, finance, inventory, everything. Better data, faster decisions, remote temperature monitoring, cuts waste, ensures safety. AI and CRM means smarter customer engagement. It's all about building a platform for efficient future growth.
And new types of stores. These bite-sized Gregs, single-person kiosks.
Very clever. Opens up totally new locations where a full shop wouldn't fit or make sense. Think train station platforms, petrol stations, inside supermarkets, hospitals, small footprint, high footfall spots. Grab and go, core menu, expands their reach significantly.
Alongside more drive-thrus, presumably.
Yes, drive-thrus remain a big focus. Convenience is king.
And maybe the biggest potential game changer, that Tesco partnership. Selling their frozen bake-at-home range in Tesco stores.
This is potentially huge. They've done well with Iceland for years, but Tesco's footfall is, what, 23 times bigger?
23 times.
Putting Greg's frozen pies and pasties in front of that many shoppers, it could easily add, some estimate, 12% or more to their total annual revenue. It takes the Greg's brand, which is seen as wholesome, reliable, right into the mainstream supermarket freezer aisle. Huge new channel.
Wow, okay. Let's shift to the financials then. The health of the business. You called it a cash-generating machine. Margins look pretty stable.
Remarkably so. Gross margin hovers around 62%. Operating margin is actually nudged up slightly over time towards 9.7%. In this environment, that stability speaks volumes about their efficiency and pricing power.
Good cost control, strong demand.
Exactly. And the cash flow proves it. $554 million in free cash flow over 10 years, most of which went back to shareholders as dividends.
And they like to keep cash on hand. Ended 2024 with $125 million net cash, though they dipped briefly into net debt in H125 because of that peak investment.
But fundamentally, they avoid debt. It's baked into their culture, gives them resilience, flexibility. They fund growth mostly from their own operations. Very solid balance sheet.
And they're very clear about how they use that cash, aren't they? Their capital allocation priorities.
Super clear. Priority one, maintain the business, about 5% of revenue, 100 meters a year, just keeping things running smoothly.
Okay.
Priority two, strong balance sheet. Aim for net cash around 3% of revenue at year-end. That safety buffer.
Priority three, dividends. Attractive, growing payout covered about twice by profits. Reliable income for shareholders. 69p in 2024, up over 11%.
Priority four, invest to grow, selectively, aiming for that impressive 25% cash return on new shops, usually hit within 2-3 years, rising to over 30%. Shows new streams are very profitable investments.
And finally, if there's cash left over after all that,
Return it to shareholders. Special dividends, they've paid significant ones in the past, or share buybacks. Very shareholder-focused.
and profitability metrics look strong too. Return on capital employed, ROCE, around 20%. Why is that important for a business like Greg's?
ROCE tells you how well they're using their money. All the capital tied up in shops, bakeries, equipment to generate profit. 20% is very healthy, especially for a business needing lots of physical assets. It shows they're investing wisely and efficiently, not just getting bigger, but getting better returns on that investment. Cash profit per share also trending up nicely pre-2025.
And earnings per share, EPS, consistently grew too, up 11% in 2024. Even if analysts see a temporary dip now, recovery is expected.
Which brings us back to valuation. It's all over the place, isn't it? Some say fair value is 22.2 now as a share, maybe 10% upside, no real premium priced in.
Others look at the PE ratio under 14x, plus a 4.3% dividend yield, and think, that looks cheap for a brand this strong.
Yeah, the Oak Blow character thinks it's clearly worth more than its £1.6 BN-ish market cap right now, given the profits it churns out.
But then there's that counter-argument. Slowing growth means metric compression. The market might just decide it deserves a lower PE multiple now, maybe 15x instead of 20x, regardless of absolute profits.
And that's the debate, isn't it? Is the current lower price a reflection of temporary headwinds and heavy investment, making it a bargain? Or is it a permanent re-rating due to slower future growth? That's the multi-billion-pound question investors are grappling with.
Beyond the numbers, though, Greg's has these softer assets, the culture, the brand strength, that employee profit share, 10% of profits shared out. That's quite rare.
It's incredibly rare, especially at this scale,
Yeah.
and hugely powerful. It builds loyalty, engagement, a sense of shared ownership. Staff feel valued, they stick around, service improves. It fosters a really positive internal community, which definitely spills over into how customers perceive them.
And externally, the brand is just solid gold, isn't it? Number one food-to-go brand, number one for value, seen as quintessentially British. It's made an impression.
Absolutely. You see that reflected online, too, on Reddit. People genuinely passionate about it. It really is more than just a bakery in people's minds, a real connection.
And they're looking ahead on things like sustainability, too, with the Greg's pledge for their ESG efforts from 2026, ticking those boxes as well.
So summing it all up,
Ugh,
yes, Greg's has hit a patch of bother. Macro pressures, cost inflation. It's tough out there.
no doubt.
But the underlying strategy, it looks robust. They are not sitting back.
No, actively investing. New shops, menu innovation, digital upgrades, massive supply chain build-out, all while keeping finances disciplined. It's quite the balancing act.
And the key takeaway, really, despite the gloomy share price charts and some soggy headlines, is resilience. The business model is adaptable, the brand is incredibly strong, the investments are strategic for the long term, and that focus on convenience and value remains absolute.
It really is a fascinating case study. Simple concept maybe, but incredibly sophisticated execution.
So, what does this all mean for you listening in? Well, maybe it shows that in a world obsessed with flashy tech and hyper-growth, sometimes the most, dare I say, boring businesses, a bakery chain focused on sausage rolls can teach us the most.
Lessons in discipline growth, long-term vision, consistent value creation.
Exactly. Perhaps those real nuggets of insight aren't always where you expect them. Sometimes, maybe they really are wrapped in golden puff pastry.